The numbers are extreme, and it kind of reminds me a little bit of the beginning of 2019, last year. So, and I think we did a video about this. Going into the end of 2018, we had that massive crash. December of 18, there was a Fed rate hike, and then there were tariffs. And the returns in early 2019 were double digits, starting in January, and then all of a sudden there was discussion, wow, we're already up 20% for the year, how much further can it go? And people sort of discounted the fact that we had just crashed. So we were coming off of a low base. And that's the same dynamic that's, I think, happening now off of the March 23rd low. You could just make the argument that we fell too far. In March, things got crazy, and people started saying, well, the economy's going to be shut down for a year. Half of the S&P 500 companies are going to end up going out of business, and there was no way to predict what earnings per share were going to be, and then what multiple you're going to put on that dollar amount. And so we just sold. It was like every day we were coming in, and the market was down between 5 and 10%. So to be up 40% off of the March 23rd level, I don't know that necessarily says anything, really. You could just say, oh, we fell too far and we had to recoup some of that. And then coming into this week, we maybe had recouped too much of it. If you consider how much uncertainty there is still in the market because of COVID and shutdowns, and there's still really not a great way of figuring out what S&P earnings are going to be for this year or even next year. So we're sort of just bouncing around in this no man's land, and people are trying to figure out how much are we supposed to be paying for stocks relative to everything else. And that's, I think, an important question is how much are stocks supposed to cost relative to everything else? So are stocks expensive right now? I can argue no, that they're not, because the Federal Reserve just yesterday, today's Thursday, so yesterday was Wednesday, June 10th, Federal Reserve came out and said interest rates are going to be zero effectively through 2022. So I can't imagine anybody is considering investing in bonds. Maybe bonds represent a place to put short-term money where you're unsure whether or not you're going to need money in the next 6 to 12 months. But bonds are not an investment at this point, and neither is cash. So those two asset classes are basically taken off the table for long-term investors. So we're kind of back to where we were in 2011, where Bernanke, sort of they call it the Bernanke put, where the dynamic was pretty similar. Interest rates were slashed down to zero, and he basically said, you got to take some risk, or else you're not going to get any return. And we're sort of back to the same dynamic, in my opinion. So we're going to have, today is painful, sharp sell-off in the market, but I don't really see any way around having investors. They're getting pushed back into taking more risk, and I think it just wouldn't surprise me to see stocks make all-time highs in the next 6 months, despite the uncertainty, despite the fact that the economy is not where it was last time. Stocks were at all-time highs. We're finding new reasons to justify a higher multiple, and as soon as we can start quantifying what price we're actually putting a multiple on, it just wouldn't surprise me. That seems to be the common theme or narrative that people are saying, is that the stock market has become bifurcated from the economy. And to an extent, it may be true. I know that there are these headline stocks. You hear people that are day trading the airlines, and Hertz is a well-known company, a car rental agency that went out of business, or they declared bankruptcy. And the stock was down below $1 after Carl Icahn exited his position, which I think at one point had been close to $2 billion worth of stock. And then the stock subsequently rallied to $5. And it's getting all this attention because young day traders are having a lot of fun buying and selling stocks that are moving around a lot. And in the headlines, you're seeing that sort of complacency or lunacy, depending on how you want to describe it. But I don't know that you can necessarily look at stocks like that, and Chesapeake Energy is another one. They declared bankruptcy, and then the stock rallied 1,000% or something crazy. There's always sort of shenanigans when a stock goes under $1, and there's short covering, and there's stocks that are thinly traded, so it's easy to kind of push them around if I'm a big hedge fund. But I don't know. I mean, I can also point to stocks that have lagged, where you could say, well, they're kind of representing the fact that the economy is struggling, and maybe we're even still in a negative GDP environment. The banks have not recovered. I know that there's some tech stocks that have hit all-time highs this week, and you could maybe point to those and say, that doesn't make sense. Well, Netflix, their numbers in terms of subscribers, new subscribers, are a record. And I know everybody's staying home, so that's the reason. Apple's another stock that just hit an all-time high. Amazon's at an all-time high. There are potentially good reasons for that, especially when you consider that interest rates are zero again. These companies have really strong balance sheets, and if they want to borrow at zero, they can do it. So they're as strong as ever. Regarding what inflation rate we're using in our assumptions, we have not made any changes to that as it pertains to the modeling and the financial planning that we do, because we don't have any reason to do it just yet. I think the reason to really anticipate a huge spike in inflation is if you're worried that it's going to that's going to become a trend, and the Federal Reserve is not going to be able to tackle it. Right. But there are so many tools they have available, which they've been kind of flexing their muscles for the last few months, right, letting us know just how much power they have when it comes to these matters. I just don't know that it makes sense to really take a drastic position when it comes to monitoring inflation. Let's just say that we are worried about inflation. That's going to be bad for bonds. And it's not necessarily going to be bad for stocks, because stocks, when you own a stock, you own a piece of a business that's got the ability to raise prices to keep up with inflation. And when you buy a bond, you've got something that's fixed, and as interest rates rise, what you bought a year ago is worth less in relative terms. So you can look at gold, which has been really performing well, and I think that's partly to do with maybe there's the inflation and deflation concerns. We did a video where we talked about gold, and it was like, do people buy gold because they're worried about inflation or because they're worried about deflation? And it's like, who knows? I think it's an uncertainty play more than anything, and I think there's a lot of uncertainty when it comes to currencies. I think the dollar has started to weaken. It's kind of been our position, or it's been something that we've been watching out for a couple of years, is the dollar strength had been a problem for overseas markets, emerging markets, because when they borrow money, they do it in U.S. dollars if it's going to be for a large amount, and for a country or a foreign company that's borrowing in U.S. dollars, if the dollar is going to appreciate against the currency that they do their business in, that can choke them a little bit over time. So as the dollar has started to weaken the last week or two, I don't know if that's been in anticipation of the Fed having to make an announcement like they just did. I don't know why the dollar has started to weaken, but I will tell you that what the Fed said yesterday is not bullish for the dollar, and that could be good for it could be good for foreign assets, and we've started to see emerging markets are starting to perform better than U.S. markets. I know it's tough to make a comparison going back just to March 23 because everything has sort of spiked, but there's been some relief for foreign currencies, and that could be good. I mean, to have the rest of the world, sort of pick up and make up for the fact that the U.S. is lagging a little bit in terms of growth rate, that could be a good thing. So it's a little funny to be talking about what could go right after we just had a massive rally from the third week in March. Today, obviously, we're seeing a little bit of a reversal or an unwind of the run-up, which is sparking fears about the second wave. Is there a second wave of COVID? Are we already seeing data that supports that we're already in the second wave, or is it just the first wave is, far worse than we expected? And there's definitely a lot to be worried about. There always is. What could go right is the hypothetical scenario where we don't get a second wave, or where the second wave is much milder than feared, or there's a medical advance. I mean, we've pointed to this in the last one or two videos that we've done. There's some sort of a medical advance, a treatment. I think everybody kind of knows that a vaccine is not something that happens quickly. It's not going to get approval, but a treatment is something that we're getting some positive. There was a commentary from Eli Lilly yesterday. Johnson & Johnson is working in conjunction with a biotech firm. There's advancements being made. It's probably not going to be perfect, and it's probably not going to be next week. But there is definitely room for positive movement on that subject. And then there's also, you asked about the jobs data and people going back to work. And this bridge that has been attempted by the federal government of getting money out to people and keeping some small businesses afloat for a period of time. Obviously, there's going to be some problems, and there's going to be some businesses that are unlucky, and some individuals that are unlucky. And but in terms of the overall economy, there's definitely a chance, there's a possibility that it goes okay. And when this extra $600 a week is taken away from the added unemployment benefits, people will have the incentive to get back to work. I know there's the question about, are people making more money by not working? Well, that may be the case, but that may not be an option forever. So when that kind of gets taken away, I think there'll be a restart, and it may be bumpy, but it's bound to happen at some point. So there's certainly still things that can go right, not without some sort of bumps in the road, but there's plenty that can still go right.
Abbiamo